Okay, we've come to my favorite chapter, and maybe the chapter that most of you, though, are dreading. And this is the one about financial aspects of operations management for retail, chapter 8. And again, don't worry, we're gonna go through this fairly quickly. There's a lot of material in this particular chapter, but I think that the fact that you can take the time to study through it and be able to respond to the questions, I think you'll have peace of mind. So let's look at some of the things that I think are important. Most of this stuff actually you've had in other classes or you will have in other classes. So it's for many of it's going to be just repetition. Um, when we talk about operations management, we're talking about things like how do we what policies do we have and how do we implement them? What tactics are we pursuing? Is it low cost? Is it high cost to make people want to buy it that have a lot of money, etc. What kind of procedures do we have in place? And we're going to have a number of chapters that are going to be talking about this. The first one is this one, financial. We're also going to talk about merchandise buying and handling, talk a little bit about logistics in another chapter. We'll also talk about human resource management. So we have a lot of chapters that deal with these things, but this is the one aspect of operations management we're going to talk about today, and that is the financial. So financial planning. I want to make a profit. I got to stay in business. I have to make a profit. I have cash and I want to manage it wisely, and I want to grow and I want to manage that wisely. And I don't want to have different departments doing things that are going to create problems with each other or that we can't pass information back and forth. So it's siloed. The information isn't there. So financial plan will help us to get all the information and have everybody working together in all the different departments. So there's a thing they call the retail accounting system, which in this book is referred to as RAS, and it's a subset of the retail information system we talked about previously. In this case, it's the methods that are used for systematically gathering, analyzing, storing, utilizing financial information. It's not just for year-end financial statements or quarterly financial statements. It's also for things like budgeting. It's also for things like bonuses. It's also for things like departments. What are we doing right? What are we doing wrong? Targets, goals, etc. And it can be done on a piece of paper, a pencil. I'll be honest, when I first moved out to Manhattan and I was an accountant for a summer, they were still doing things with the blue, the green lined counting paper and those big books. And I was like, this is crazy. This is insane. It was a small company. It got bought pretty quickly, but you will still see that from time to time. Major financial statements that we talk about all the time in accounting and in finance and now in retail, you can't get away from it. Things like the balance sheet, the income statement, and the statement of cash flows. Those are the three biggies that we'll talk about. So balance sheet, it's like a snapshot of where things are at the end of the year, at the end of the quarter, at the end of the month. It's usually the one that would be discussed the most. It itemizes the assets and the liabilities and the net worth. And we've got some formulas that you can use to analyze that. The two sides will always look sort of like a T, but the two sides will always equal out in the balance sheet. The second type of statement is an income statement, and this is more like a movie than a picture, and it shows sort of what happened over the course of the year or the month or the quarter. And in this case, it's got different components from the top to the bottom, so we can kind of read it as a flow and understand what's going on with the money that's cascading through this. So we got sales, what's the cost of the goods that I'm selling, what's my profit after that, the gross profit, what kind of operating expenses do I have, take that away, what's my net after I've taken away the operations, maybe I get some other kind of income or other kind of expenses. I'm going to have to figure out what that is. That's my bottom line before taxes, but then I have to pay taxes, so obviously I have to pay that, so I have to take out the income taxes, and then I got my net income after taxes, my bottom line. What really sticks to my ribs. So that would be an example of an income statement. In the statement of cash flows, it's a very important document, and it shows what's happening with the cash receipts and the cash payments during the particular period of time. So cash is really important. I may have people owe me money and I can say, I'm going to be paid next Tuesday, but I might need to pay them, my employees or whatever right now at the end of the month. And if I don't have that cash, I may have these IOUs, but that's not going to do me any good. I have to that cash. So this statement of cash flows will let me see where the cash is, where that stands right now. It's got three different components: operating, investing, and financing. And those would be subsets underneath the actual statement of cash flows. There's different ways of analyzing financial statements, and we'll talk about, the book talks about, I should say, horizontal analysis, like how things have changed over time. We got vertical analysis. It's also known as common size or percentage. So I might have Pepsi and I might have Coca-Cola, but they're different size companies. And instead of having the dollar amount, I might just have the percentage. What percentage is assets of this type? What percentage is liabilities of this type? And I can compare these two different size companies, okay? There's also a thing called ratio analysis, so we spend a lot of time doing that as well. And a ratio analysis is for me to say, for every one of these, I've got a fraction of this, and it gives me a ratio between those two things. Three main types of ratio analysis, and this is usually I'm taking the financial ratios to do this. It would be liquidity, activity, or efficiency. So liquidity would be things like the current ratio, the acid test. These would be things that show me my current assets, my current liabilities. What am I going to have coming in? What do I have right now? What do I have to pay very shortly? Okay, so that's what that current assets, current liabilities would. Activity ratios would be things that how well am I managing my assets or paying off liabilities or using my assets to generate sales. So these will be things like accounts receivable. I may have a lot of accounts receivable. Is that a good thing or a bad thing? What's an account receivable? It's an IOU. Do you want to have a lot of IOUs? You can't take them to the bank. That's a bad thing. So I want to be able to get that money in the door. So this would be a good way of saying, you know, it only takes us 15 days to get this rather than my competitor, which is doing it in 35 days. We're being more efficient in getting the accounts receivable coming in, for example. And there's other things that have to do with inventory and sales, etc. And then there's efficiency ratios. And this is how effectively the management is running the business. So it might be things like return on assets. So I have all these assets, this machines and things like that, saying I've spent all this money on. How are we using that? Or return on equity. How much have the owners, been putting into this company? It's now in part of the balance sheet. You can see the equity, owner's equity. What kind of return am I getting on that equity that's sitting there? Return on sales, debt to equity. What's the net worth after I take the debt out? How am I doing with that? So these would be examples of efficiency ratios. There's a term called asset management, and in this case, asset management is I want to have controls in place so that I can use those assets to their full potential. Let's take, for example, carrying costs. I have to have something, but if it's just hanging around in inventory, and I may have a very large inventory, it might cost me a lot for having that inventory. It could be all sorts of things that would cause that kind of financial leakage. It might be the fact that it's expensive to store this extremely cold item. I have to run the electrical all the time to keep the temperature low enough to be able to store this thing, etc. Those would be examples of carrying costs. Types of fraud. So again, if you're going to be buying a retail place, one of the things that you would have your accounts look for are fraudulent ledger items, fraudulent financial statements that have been set out there. Revenues that don't exist, fictitious revenues, asset violations. You shouldn't have done that. You shouldn't have showed it that way. It should have been tagged something else. Timing differences. Yeah, you said it was in 2017, but really it was in 2016 that payment occurred. Concealed liabilities, offshore accounts that nobody knows really what's in there. Improper disclosures. We claim this and really it was the other, and that's not right. So those are examples of fraud that can happen out there. Budgeting for merchandise and forecasting. Again, we can go bottom up or top down. So with budgeting, I might start with what we have down right at the sales level right now. That would be a bottom up approach. Top down, I don't know why it says bottom down, but top down approach would be something where I am actually saying, okay, we've only got this much money and we're going to use it this way, and I'm the boss and this is just the way it's going to be. So again, bottom up, we're sort of where we're at right now. Top down would be more along the lines of this is the way it's going to be. I'm just telling you this is the way it's going to be. And again, we're going to have a certain degree of accuracy demanded in this. It can't just be something we make up. Because if we're going to be forecasting, we're going to be buying. It's a retail. We're going to be buying stuff based on a forecast for 9 months or 12 months from now. So I have to be able to get that as close to as it possibly can be. And we need to have flexible budgets. If there's a change in the economy, we need to be able to deal with that. We forecast. We look at the beginning and end of month stock. We plan for reductions. We sell out of things. We plan on purchases. We plan on what price and cost we're going to have to pay for or sell those items, and we got to figure out the gross margin that we're going to have. Inventory, there's a couple of different ways you can value your inventory. First is a cost method. That's, what is the merchandise cost? Okay, so I value it in the inventory based on the cost. And then the other way of valuing inventory is the retail method, which is what am I selling it for? Or at least what is my retail price? So again, cost is going to show it lower, retail is going to show it higher. Cost method, I want to have coding in place. I can have this in a way that that's clear to me, but I don't want customers necessarily to know, hey, I'm paying 50% more than they are for this item, etc. And then we've got issues like how often are we doing this? Is it the first in or is it the last in, etc. Retail method, there's some problems obviously with that cost method. This helps to overcome some of those things, but I'm going to be using a lot of averages. There's a lot of approximations and a lot of computerized systems are really needed to be able to get this done right. The book talks through how we actually do the calculations. I won't walk through that, but it's going to give you a book value inventory. Resource allocation. So in this case, I am using the financials to be able to say, we want accurate financials, and I want them to be able to say to me, this is going well and this is going badly, and I want to adjust things to deal with that. Okay, so I really want to have good financials, accurate financials, good numbers, and I'm actually using the numbers to make decisions that I'm running the business on.